Hello, and welcome to the Traders in the Know channel. Be sure to hit the like button and subscribe. Leave comments below. As you can see from the thumbnail intro, it's a look at the impact of Trump's trade tariffs on financial markets. Unless you've been living under a rock for the past few months, you'd be aware that the world is about to embark on a global trade war. Wednesday, April 2nd, 2025 will now officially be known as Liberation Day, as proposed by the leader of the free world, President Donald Trump. Crazy King George. Maybe. Is there method to the madness? Well, whatever you believe, the world and financial markets brace themselves. And in those immortal words, let the games begin. But be sure to watch to the end and see some strategies that could possibly combat the negative impact of tariffs. So, what might we expect? Whether small traders or big investors here, is 8 possible ways Liberation Day could impact you. 1. Increased volatility. Announcements of new tariffs often lead to heightened market volatility as investors adjust their expectations about future corporate earnings. Point 2. Sector-specific effects. Industries that rely heavily on imported goods or export products to tariff-imposing countries, such as semiconductors. Automobiles and consumer electronics can experience immediate price movements. 3. Supply chain disruptions. Tariffs can disrupt global supply chains, leading to increased costs for companies that rely on imported materials, which can negatively impact their stock prices. Point 4. Corporate earnings pressure. Higher costs due to tariffs can squeeze profit margins, leading to lower corporate earnings and potentially lower stock prices. Point 5. Shift to defensive stocks. In times of tariff uncertainty, investors may shift their investments to defensive stocks, such as utilities or healthcare, which are perceived as safer. Point 6. Retaliatory measures. The imposition of tariffs can lead to retaliatory tariffs from other countries, further impacting international trade and the stock prices of companies involved in global markets. 7. Investor sentiment. Frequent changes in trade policy can erode investor trust and confidence, leading to a more cautious investment approach and potential declines in stock market indices. Point 8. Economic growth concerns. Prolonged trade disputes and tariffs can slow down economic growth, which can negatively affect the overall stock market performance. In troubled times, gold is always considered a safe haven, a defensive stock or measure. And what is the news saying around the rest of the world? Do you think international news media sound worried? They all seem to be raising alarm bells and expressing concern. News anchors, economists, finance experts, and governments around the world scramble to predict the next move. The list of things shown in the video so far are obviously not the only things that can happen, but do give us a good idea of what's to come. Undoubtedly, the rest of the world will likely retaliate with tariffs of their own, even if only just to use them as bargaining chips against America. This is the nature of trade wars, and most of the time, everyone is left all the poorer for it. But now, as promised, here are 5 stock market strategies to help mitigate price fluctuations due to trade tariffs. 1. Diversification. Spread investments across various asset classes and geographic regions. This reduces exposure to tariff-sensitive industries or countries. For example, combining U.S. equities with international stocks and bonds can provide a balanced portfolio. 2. Invest in resilient companies. Focus on companies with flexible supply chains that can adapt to changing trade policies. Firms with diversified operations or backup suppliers are better positioned to handle tariff disruptions. 3. Favor domestic-centric investments. Invest in companies that have a strong domestic focus and minimal reliance on international revenue streams. Small cap and mid-cap U.S. stocks often benefit from lower exposure to global trade uncertainties point forward. Quantitative risk management uses tools to assess portfolio exposure to tariffs under various scenarios. Analyzing correlations with tariff-sensitive sectors or countries can help identify and manage risks. 5. Stay informed and avoid overreaction. Keep up with trade policy developments, but avoid making impulsive investment decisions based on short-term volatility. Adhering to long-term strategies can help maintain portfolio stability. There you have it. I hope this video was helpful. Give a thumbs up and hit the notification bell for future videos. Don't forget to leave your comments below. And remember our motto, whether in business or finance, protect yourself at all times.